Welcome to Beyond the Dollar Signs, a financial podcast dedicated to helping you gain financial clarity in a complex world. I'm your host, Mark Taylan, alongside my colleague, Bill Tucker. Today, we're exploring reverse mortgages, a financial tool many people misunderstand. To help us break it all down, today I'm thrilled to introduce Mike Brouse, a reverse mortgage specialist from Rate Mortgage. Mike, welcome to the show today. How are you?
I'm good, Mark. Happy Friday to you.
Same here. It's good to see you. And, I've always liked to learn a little bit about our guests. So I'd love to hear a little bit about your backstory. If you'd like to share that. How did you get into reverse mortgages?
Yeah, absolutely. So as you know, the mortgage industry is not something you go to college for. A lot of people that fall into it kind of are invited into it, or they look at the landscape and say, hey, I'd like to be a pivotal part in somebody's life in helping them, purchase their first home. So that was kind of my journey. I actually spent 8 years in the United States Coast Guard. Then when I got out, I already had started a family. And it was like, okay, if I'm going to be the sole resource for our income, how am I going to do this? I didn't finish college. And I did have a lot of leadership experience, and I had a mortgage. I did know that there was a G in mortgage, but other than that, I had no idea about the world of real estate finance. So
I see.
I got invited to look at the opportunity with a local company in Marin, California here. And I joined, and that was in April of 1999. And then probably a good ways into my origination career, I started helping some folks with a reverse mortgage. And I actually helped my in-laws with one. And that was a learning process. And I really saw how it made a difference, not so much when we did the reverse mortgage for them, but it was really like 3 or 4 years after after we got the reverse mortgage in place and my father-in-law passed away. And I really didn't know about, all of their finances, but the reverse mortgage really made it possible for my mother-in-law to continue her, lifestyle in this chapter of her life going forward without my father-in-law. So I really saw the impact. And then probably 4 or 5 years ago, I really began to approach this in earnest and say, you know what, there are a lot of moving parts here. I've got my forward mortgage background and my financial planning background because I've been licensed on the life insurance side for years. And I've done my 6 and 63 coursework years ago. So I kind of wanted to be a 360 advisor, if you will, focusing on the equity in the home.
Right.
So when I began to focus on reverse mortgages, it was really just a transition from my traditional practice, because had always kind of been like yourself, a holistic planner. It's just I chose to focus on the debt side, which was the equity in the home or the mortgage. So about 4 or 5 years ago, I said, look, I've been helping families in Sonoma, Marin, and Napa counties, for 22 years, 21 years, helping them integrate equity into their overall long and short-term financial plan in the accumulation phase, right? And so we all know that, there's an accumulation phase, and then there's the distribution phase.
Right.
So in the accumulation phase, they're buying the home, they're funding their retirement accounts with the sole purpose and idea that someday I'm going to use the money that I've squirreled away or socked away in these pre-tax arrangements or after-tax arrangements for the sole purpose of using them when I decide to stop working.
Sure.
So that's really what I began to do. So it was just like, okay, we're not focusing on accumulation anymore. We're focusing on the distribution phase. And then I really began to say, there is a lot of power in looking at the equity in the home as a resource rather than it just being a, sacred cow in a lot of people's eyes.
Yeah.
And that's not to be touched. Don't mess with that. And so then I really began to rethink some of these things and go, hey, wait a minute. We work with people that spend their whole life putting money in their, pre-tax retirements, their after-tax retirements. They may be involved in the stock market as a, just as a day trader or whatever, trying to boost that, resource that they'll have. But again, the whole idea is like, why are they doing that? They're doing that for when they stop working their job, that they have some money that they can pull from in a strategic way, and that's going to determine, their lifestyle in this chapter of their life. And I said, wait a minute, people are paying into a mortgage. They're paying money to the bank in a mortgage.
Right.
That's not making the home any more valuable.
Right.
Right. That's a concept right there that, a lot of times it gets overlooked. So, they're feeding the bank with monthly mortgage payments, but the equity growth in the home is almost a given. Not guaranteed, but where we live, Northern California, all over California, really. I mean, just tremendous growth. So I begin to have people question, why don't they look at their mortgage and the equity in their home as an additional asset for that? So that was kind of I know you asked me, how did you get in the mortgage industry? I'm explaining all these things, but that's kind of what drew me into it, based on how I started my practice. And here's one other thing, Mark, I got clear a long time ago through the help of, kind of a coach. They said, Mike, what do you, you're helping all these people. What does that mean to you as far as, legacy? You spend more time at work typically than you do at home. Sometimes people haven't thought of that, but it's actually true. And I thought, what, if I know the number one reason for divorce in America is financial issues. So if I can affect that's legacy material. That's what I get up every morning going, how am I going to help people help themselves with their finances? And then number two, a lot of people don't know this, is that the number one reason for suicide is having no hope around financial matters.
Right.
So I got, those two things right there are what drive me in my practice, to help as many people as possible. And let's not get it twisted. Gray divorce is hugely on the increase, right? Which is not good. It's not good. People who live together for 30 years, all of a sudden decide they can't stand each other. And what are we going to do with the house? And how do we divvy up the asset? So, those are just one of the things we don't talk about often. And then, of course, people get to that retirement age and it's like, holy smokes, we've got what we've got. What are we going to do? And then they decide to, end their life because they can't deal with the pressure, or they don't see a way forward. So anyways, that's kind of, I know I kind of went on a down note there.
Oh, that's great. I really I love the backstory. I love the passion in regards to how you utilize the home, right? And it's often it's often an asset that I find that people, really don't understand how they can utilize that tool in a favorable way, from whether it's a retirement income strategy. There's so many different applications of reverse mortgage. I think the skill set to be able to talk to clients has to be from a holistic planning standpoint, right? And as a financial advisor, when I've done this 20 plus years, it's often an asset. And I think you kind of alluded to this, is that people don't really think of it as it's just equity in the house. How they don't understand how to access that and what that can do to help mitigate other risk or add another layer of access to income in the future. So I appreciate that backstory. I really do think it definitely people need to be aware of how to best utilize that asset. Let's start, reverse mortgages. Whenever people hear that for the first time, there's definitely a lot of misconceptions. And, when I've looked at them in the past, and I have that experience as well, where we've done a reverse mortgage for family and seen that positive impact. But let's talk about some of the misconceptions and some of the basic things that people are really nervous about, because what I find is that misconception, it's like you have to break that barrier and that misconception before they'll even listen to that information. And I also find that because most of the people that are would consider reverse mortgage are, 60 plus, I often find it's a really, you have to involve the family, right? And so I think those are really important things. But I'd like to hear, what your thoughts are on the biggest misconceptions about the reverse
Yeah,
mortgage.
Mark, absolutely.
Yeah,
So can we do a pop quiz?
sure, of course.
Okay. I know for you, I know that you know the answers to these, but for our listening audience, it might be a kind of a fun way to break through to the truth and
Sure.
dispel the myths about this product. So it's good. They're going to be true or false questions. All
Okay.
right. And okay, no pressure now. Okay.
You're gonna put me on the spot. Let's go.
Yeah. Well, yeah. He's like, come
All
on,
right,
bring
let's
it.
go.
All right. Well, here's the thing. So question number one. Um, when you do a reverse mortgage, the bank owns the home.
That is
So
false. Yes,
that
that is
is
false.
false.
That
That
is
is
false.
false. And that's the biggest misnomer about reverse mortgages, is that the owners of the home are on title and there's
Correct.
just a lien against the home in the form of a reverse mortgage like any other mortgage. So good. We got that one. So
Yes.
that is false. The bank does not own the home. The
Yeah.
homeowner owns the home.
They never lose control. I mean, it's just like any other regular mortgage. It's something that can be paid off in the future. It's just a
Right.
lien on the home like a traditional mortgage.
That's correct. Yeah, that's
Okay.
right.
All
Good, you
right.
got it. Okay, number two, ready?
Go ahead.
Okay. So any remaining equity when the homeowner with a reverse mortgage leaves the home permanently, whether it's dying or moving somewhere else, any remaining equity stays with the bank.
That's false.
It is false. Yeah, and you'd
Yes.
be surprised how many people think that the bank, they own the home, they're going to keep the equity. I'm losing total control. That's like,
Yes.
no, no, no. Any equity remains with the estate. So at the end, the mortgage has to be paid off,
Mm-hmm.
but that can be done through purchasing the heirs purchasing the home or selling the home for fair market value, on the open market. But
Mm-hmm.
any remaining equity stays with the estate, and it's always good to have a trust in place so there's no questions about who's going to do what at the end. So good, 2 for
Okay.
2.
2 for 2. All
Look,
right.
yeah, and this is the third one is kind of like this one scares a lot of people. And I don't know if you know or have read, or you probably have, the number one fears among seniors. The number one thing is running out of money.
Mm-hmm.
So when we talk about financial independence, we're saying that they're able to remain in their home, age in place, without having help from family members, right? Family members, or taking drastic measures to figure things out. Like I've known of people who have brought total strangers into their home to rent a room. That
Mm-hmm.
is all kind of bad. Okay.
Yes. Right.
So the true or false question is, true or false, if the homeowner gets to owing too much money on the reverse mortgage, the lender is going to kick them out of their home.
That is false because it doesn't matter if the mortgage is upside down. It doesn't matter if the loan is higher than the equity in the house. They'll never have to leave the house. I mean, they'll never.
That's right.
The bank will never force them to leave the house. At the end of the day, they still own the property. Yes.
They own the property and they're contractually guaranteed to be able to stay in the property until
Correct.
they leave permanently. As long as that home is their primary residence, it doesn't matter how big a loan balance gets. As a matter of fact, there's a feature called a non-recourse feature.
I was going to say that the non-recourse features. Yes.
Yeah, I don't know if you want me to get into that or move on, but that's the actual technical term that's very unique to reverse mortgages, and that's what means that the borrower can never owe more than the home is worth, and therefore they're contractually guaranteed to be able to stay in the home. So when we talk about financial independence, they have a place to live, they're in their home where they want to be, and that is really what this program was designed to do, is to keep people in their home where they want to be. As a matter of fact, like over 75% of senior homeowners want to stay in their home. They don't want to go somewhere else.
That's right. And there are provisions, as we know, if they had to go to a rehabilitation center. Can we talk a little bit about that? If they had to leave the home, typically, what is it, a 12-month time frame where they have to go back to the house, or else it changes correct?
Yeah. So here's one thing that I can answer that question, but maybe connect some other dots along those lines.
Right.
So there's three things that can cause the reverse mortgage to become due and payable, or what some people call a trigger event. Okay. So number one is the homeowner has to pay their property taxes and homeowner's insurance on time. So as agreed, because a lot of people don't know, and I know you know this, Mark, but the property taxes are the first lien against any property. And the way I always think about it is the way I think about it is in my little primitive way is that the land was there first. Okay?
Right.
So you got to pay the county for the use of the land and the house, of course, but in the form of property taxes. So those have to be paid. The second thing is there is a letter that goes out from the servicer of the reverse mortgage every year on the anniversary date. Well, it's usually around December, regardless of when they did the loan. But they're just saying, hey, this is our primary residence, and this is how many people are living in the home. That's really it. And then I always say, kind of as a joke, that, hey, the third thing is you can't open a Harley Davidson repair facility in your living room.
I see.
Okay?
Yes.
And they laugh, like, yeah, that's I kind of lighten it up with that. And I go, they just want you to take care of the house.
I see.
So with regards to leaving and coming back, there are, like if you look at the rule book, as long as, like, if you leave the home to go to have a procedure and then you're in rehab, but your intentions are to come back, that's fine. It's when somebody goes, okay, we're packing up. We have to go into a care facility where we need around the clock care. We need somebody to administer medication that is unable to be administered in the home,
right,
even by a home health aide. There's non-medical things that home health aides can do. When it comes to certain things, you actually need somebody who's licensed at that level.
Sure.
And at that point, it might make sense for them, to be in a facility where they're going to have that, on-call nurse or doctor, to help them. So it is about a year. You're absolutely right. But there are people that, they know the rules and they'll figure things out. Now, here's another thing. There are people like more on the East Coast that own a home in Pennsylvania,
right,
but then they'll go down to Florida. And so as long as they're occupying their Pennsylvania home, like 6 months and a day, that's considered their primary residence.
Yeah.
I'm not a CPA, but for tax purposes, that's the way that pans out. So you don't have to actually, like, you could go on a cruise for for several months, but as long as the home is your primary residence, and you attest to that every year, that's that's your primary residence. That's where you live, and that's not a trigger event.
Can we talk a little bit about, we've got a regular mortgage and people understand I've got to make that mortgage payment, which typically includes, if it's escrow, it's got taxes and insurance, or they may pay that separately. But what are the mechanics? Like I've got a client's got a reverse mortgage, right? What's different about the month-to-month payment like that? What's technically happening with the loan that they have? Can we talk a little bit about that so our viewers can understand, like, what's different about this? Do I need to make that monthly payment? I want to make sure that they're clear on what the mechanics look like from month-to-month basis when they have a reverse in place.
Sure.
Yeah.
So with a reverse, there's never a minimum payment due. Okay. So like we said, they have to pay their property taxes and homeowners insurance. But there's never a minimum payment due on the mortgage. But also they can make payments if they want to. So there's no rules against that either. But maybe to better answer how a homeowner who is making mortgage payments can feel a ton of relief by not having a mortgage payment.
Yes.
Let's start by saying there's three main, types of folks that we help.
Right.
The first folks are, and it is known as a mortgage of last resort. In other words, you either have to do the reverse mortgage or you have to sell the home.
Right.
Okay. And it's no problem if you have to sell the home, but a lot of people like options. I know I do.
Sure.
So in that case, maybe the homeowner has a mortgage and that payment is, $1,500 a month. let's just use round figures,
Sure.
$1,000 a month.
Yes.
So effectively, when they come to us and say, "Hey, our cash flow is really, really tight right now. How can a reverse mortgage help me?" It says, "Look, well, the first thing we're going to do is pay off that mortgage if there's enough equity, and so that's $1,200 or 12,000. Let's see, 12,000, right? $12,000 a year. It's going to stay in their checking account,
right,
where they aren't going to be writing that check to the bank." Okay, so right there, we've kind of solved a mini problem in that we've eliminated their mortgage payment, which will allow them to have positive cash flow. So that right there can change a whole scene, in itself. But then a lot of times, not only will we pay off the existing mortgage, but we'll create what's called a line of credit that they can draw on as they need. So that's the mortgage of last resort. Can I go to like the second group of folks? Because I feel like this is the larger group of folks that I personally help.
Yeah, absolutely. Before you go there, though, so in that event, let's say a client had a $250,000 mortgage. They're paying $1,000 a month towards principal and interest. So now it gets replaced with a reverse mortgage. So now they've got a reverse mortgage in place at $250,000 and whatever that number is. We'll just use that for now. So effectively, what's happening is, and you correct me if I'm wrong, but now they're not making that payment. Now they're holding on to that. But the bank is still making interest on that $250,000. So effectively, is that mortgage is going up slowly, correct?
Yeah.
Yes.
Yeah, it really is. Okay, so one of the first things to know is that a reverse mortgage, because there's never a minimum payment due, it is a negatively amortizing loan. In other words, each and every month, the balance of that loan is going to grow. Again, because there's never a minimum payment required.
Right.
And so with every one of our proposals, we provide an amortization schedule. So the customer can actually look down and see, okay, this is my loan amount. This is what it's growing to every year. This is the equity in my home. This is what it looks like. So at the end, we pay off the existing reverse mortgage and we balance that against the available equity.
Sure.
That's what the estate gets.
So, go ahead. I'm sorry to interrupt. Go ahead.
No, go ahead.
Yeah. So I'm thinking about it from a number standpoint. You've got a $250,000 mortgage as a starting basis, right?
Sure.
$1,000 a month. Let's say it's increasing by $1,000 a month, so $12,000 a year. In 4 years, hypothetically, that mortgage could be $300,000, right? In 4 or 5 years, right? Because the mortgage balance is negatively amortizing, so it's $300,000. So then an event happens where they pass away, or they want to take that, or they pass away. What's left is that house may be worth $800,000 against the $300,000, which is the reverse mortgage balance. The equity is $500,000. Is that fair to a good analysis? And so I always think of, when I've seen their illustrations, what we expect, especially in California, is property values tend to increase 3 to 4% a year, from in natural inflation and growth. So eventually what you see is, maybe in the projections, when somebody's looking at an illustration, you're seeing potentially the reverse mortgage balance going up if they're not making any payments, but also you would expect the equity in the house to go up as well. So I think that, people really need to understand kind of of what's really happening behind the scenes. They still own the property, the value's still going up. Yes, the reverse mortgage is going up, but there's still equity there. So it's a really interesting, from a standpoint of from having a client understand like the mechanics of it. And that's where I think a lot of the misconceptions come in, because they don't really understand what's happening with the mortgage itself, the equity, and what that looks like long term for the family in the future. I think that's key.
Mark, yeah, you're exactly right there. And here's one thing too, that when we were talking about the common myth perceptions or misconceptions.
Yeah, I'd like to talk about
we did that little true and false exercise we did there. One of the biggest things too, especially among financial planners, of course with consumers, but sometimes with financial planners, they're not aware that we're only going to 40 to 45% loan to value.
Yeah.
So if the reverse mortgage was represented as a pie chart, you would see a little sliver, about 40% of what we're actually using of the overall equity.
I see. Yep.
So a huge part of that is called equity reserve.
Mm-hmm.
And some people are saying, wow, that doesn't seem like I'm getting a lot. But on the other hand, they're saying they're not happy when we're leveraging all the equity. So
That's right.
Okay, the way it's set up is we're not leveraging a lot of equity. So, if if you don't have 50% equity in the home, you're probably not going to qualify.
Gotcha.
Okay. If you own the home free and clear, $1 million home, you're probably going to leverage, depending on your age, maybe 450,000. So as we look at those numbers, and to your point, the chances of the equity reserve being eaten up in a 15 to 20 year period is not very likely, especially in California,
right?
Because of the growth.
Yeah, I definitely agree with you. I think there's a lot of advanced strategies that I would love to talk about. We're going to have to do an episode 2 for that. But before on this episode here, what I'd like to also talk a little bit about is some of the baseline qualifications. Like when can people really consider this as a tool? What are some of the qualifications they need to have to be able to do a reverse mortgage?
Sure. So it is age driven. It's got to be a senior homeowner. So there's kind of 2 flavors when it comes to the reverse products. One is the FHA insured reverse mortgage, and we use a really popular acronym for that called a HECM.
Okay. What does that stand for? I've heard that word, but what does it stand for?
What the HECM?
Yeah.
The HECM is home equity conversion mortgage.
Ah, gotcha. Makes sense.
So when Congress got together and said, hey, how are we see this large segment of people aging in the future, the generation of the baby boomers, really huge. And so they said, okay, how are we going to address this? Because they knew back then that there was going to be cash flow issues.
Mm-hmm.
And then this is another thing we can talk about, but the reason 80% of Americans cannot retire, that's a huge number. The reason they can't, and it's not the financial planner's fault.
Yes.
Back then they were working with different numbers and like a 4% withdrawal rate. It's not 4%. You're this is what you do. So I don't want to pretend like, I got it all figured out, but I have had customers coming to me that said when they were starting their retirement planning in the early 90s, that this is what they were told would work. Mm-hmm. And it's like, it's not.
Yeah, so, the 4% has been debunked a bit, right? With they didn't stress test certain environments, sequence of returns. So it's really not a a more modern technique that we use these days.
Yeah. I love the idea of the Monte Carlo modeling. Mm-hmm. But if you don't put the right info in,
that's right,
you're going to get a totally different outcome.
I completely agree with that. Yeah.
So a lot of people talk about the 70-cent dollar.
Yes.
That we go to work for the first 3 months of our, as a W-2 wage earner.
Yes.
The first 3 months goes to Uncle Sam. If you really want to look at how the dollar's divvied up and what comes to us. So the idea is, and I know you talk about this, and this is part of your deal, is the tax thing is huge. Like, where can we get tax-free dollars from?
That's right. Oh, that's such a big topic. Yeah.
It's such a huge topic. And I know I don't want, I know you're trying to, let's get back on track, Mike.
I know we can go, Mike, there's clearly a lot for us to talk about in the application of reverse mortgages. I'd like to take a break really quickly, and then we'll cover that in episode 2.
This is a great conversation, Mark. And Mike, thanks for joining the podcast. It is fascinating. And I think, Mark, you're right. I think there's a lot of misconception about what a reverse mortgage is. And this has gone a long ways to sort of clear up, I think, some of those myths that are out there floating around about the bank is coming to take your house away from you. I'm looking forward to part 2 of this because as Mike has hinted at in his conversation with you, Mark, that this is a legitimate financial tool. And I can't wait to hear how people have used it to make their life better and to improve their financial planning. And for those of you who are listening to this podcast, who are not clients of Mark, but maybe want to have a conversation with him, Mark, what is the best way for them to reach out and at least initially contact you to talk to you?
You know, the best way, Bill, is by email or by phone, which will be in the show notes.
That's excellent. And I'm glad you put it that way, because oftentimes people are listening to these podcasts and they're driving. They're doing other things. They don't have a pen in their hand or a pencil. So it's there. It's in the show notes. The other thing you can do right now while we're still talking is hit the follow button. Become a subscriber to the podcast if you're not one already. Why is that important? Because as a subscriber, you will automatically be notified when Mark drops the next edition of this podcast, which means you'll be automatically notified when part 2 gets dropped and you can continue to listen. So thank you. I'm Bill Tucker. On behalf of Mark and everybody at 360 Advisors, I want to thank you for taking the time to listen today. Stay tuned for part 2. Mike's not going away. He'll be back. Thank you for listening to Beyond the Dollar Signs Financial Clarity. Click the follow button to be notified when new episodes become available. Visit our website at advisors360pwm.com or give us a call at 408-778-8280. The information covered and posted represents the views and opinions of the guest and does not necessarily represent the views or opinions of Advisors 360. The content has been made available for informational and educational purposes only. The content is not intended to be a substitute for professional investing advice. Always seek the advice of your financial advisor or other qualified financial service provider with any questions that you may have regarding your investment planning. ECA does not provide tax or legal advice. Guest opinions are their own and may not reflect those of ECA. The viewer is encouraged to seek their own individualized tax and legal advice from a qualified professional.